in listen-only mode.
Good evening and welcome to tonight's Premium Account Live Market Update webinar. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter tonight, myself, Leon Hein, current Managing Director of Global Equity Management. The format for this evening's presentation, we look at the global macro outlook driving equity markets. We roll through the ASX top 50 companies. We review the early part of the US June quarter earnings. As we move through the top 50 companies tonight, we'll take a specific note of PE valuations as we approach Australian earnings season kicking off in the coming weeks. And we'll also look at this insatiable demand for yield, which is driving this rotation out of cyclical or growth stocks into defensive names. And as we roll through the top 50 stocks tonight, we'll pay close attention to the trends that are fairly embedded in investor money flows within the top 50 companies at present, and conclude with the short-term outlook on the Australian market. The services that we provide are up on the screen there, and if you'd like to know more about those, contact either myself or Christine, info@investorsignals.com. Up on screen there's a graph of the Dow Jones, and I'll just move straight into the short-term news flow that's impacted the market just over the last 24 hours. So stocks shook off the Fed chief's dour view of the state of US growth, reversing early losses on hopes that central banks might be forced to come to the economy's aid. The Dow Jones Industrial rose 78 points, so finished at 12,800. The blue chip fell hard after Federal Reserve Chairman Ben Bernanke gave few clues that the Fed would take imminent steps to support the US economy, but the Dow Industrial stormed back late in trading, and the market finished up marginally, as I said, 78 points. Coca-Cola was one of the strong advances in last night's session. Goldman Sachs reported their results. So we had JP Morgan out on Friday, which I suppose the result met market expectations. There was some relief that the trading losses were not at the top end of the range there. There was concern that they may top sort of or trend up towards $9 billion, so there's some relief that that didn't happen. But generally speaking, across the investment banks, even though Goldman Sachs stock price was up marginally last night, and the investment bank reported second quarter earnings revenue that exceeded expectations, on the previous corresponding period earnings are down, and that sort of flowed through to Goldman Sachs, providing commentary to the market about their continuing to cut costs and looking for a further $500 million in cost savings. And I think that just goes to the fact that these investment banks are probably finding it more difficult in the current sort of environment to drive sort of earnings growth out of their sort of proprietary trading business models. And that's something that we're kind of seeing, globally as a trend. In US economic news, consumer prices were flat in June, in line with expectations as energy costs continue to fall. Industrial production picked up in June, rising slightly more than expected. And elsewhere, home builders' confidence in July had the biggest monthly jump in nearly a decade. So we've started to see a continuation of data around the US housing picture over the last 2 months, gradually start to look a little better. So that's something that of a bright spot that's continuing in the most recent data flow. From an earnings standpoint, the S&P 500 companies are tracking roughly at a 2% contraction from an earnings standpoint to the previous quarter. So as you'd know from prior webinars, we've been looking for the S&P 500 to deliver $25 of earnings in the June quarter. That would simply match what they delivered in the March quarter. If you apply 12 times earnings, you arrive at our fair valuation for the US market, or for the Dow Jones, which is 12,500 points. We've spent the most part of the last sort of 6 months tracking at or near that level, and we actually don't see too much change in that picture over the next 6 months or more. And I think that's really predicated off the back of global GDP growth falling back from sort of mid-4s to high threes, low fours, and in that environment it's pretty hard to build a case that the big multinational companies in the US are actually able to grow earnings in a constrained sort of global growth picture. Central banks are acting quickly to provide liquidity and provide stimulus, and I think sort of at best what we get is the global economy sort of maintaining some level of cruising altitude, which is largely supported by central banks. And I think in that environment we're unfortunately set for a very flat earnings growth environment for the US economy. And whilst there might be deep discounts around the world within global equity markets, it's hard to see them really adjusting anytime soon, and again we'll get to that as we get into the top 50 companies. So our base case for the US is that unfortunately it's more of the same, that we struggle through the June quarter. We probably deliver earnings just shy of $25, which is what we've been expecting for the last few months. Central banks gradually start to provide support to the global economy. We probably get into the September period where earnings would have been down maybe as much as sort of 5 to 8%. I think probably central banks do enough to keep earnings and to keep the share market looking forward sort of 6 months to an environment where we sort of see earnings maintaining at around that sort of annual rate there of $100 for the S&P 500 companies. Moving off from the macro picture with the US market and just moving on to sort of the impact that China has on Australia, and we've been tracking this for some time. Our base case is that the policy response out of China is gradually, so if you go back 12 months ago, obviously China had an issue with inflation, and the policy response there was to increase the cost of funding and tighten up money supply in the banking system. And unfortunately that started to take effect really at the same time that the European slowdown started to kick in. So I think the policy response out of China, they've certainly achieved their outcome of taming inflation, but now it becomes an issue of stimulating growth, and we're just starting to see policy responses come through. Now, as far as commodity demand from China, all the evidence suggests that certainly June port data was strong. So from a shipping standpoint, the three big miners being BHP, Rio, Fortescue have all come out with their production reports, and I'll chat about that in a moment. They were all quite strong or reasonable for the June quarter. The big issue that's impacting commodities or at our bulk commodity plays is the euro dollar, and I'll get to that again in the moment, and the unwind of the carry trade. But from a big picture standpoint, I think we can be reasonably confident that the policy responses out of China and their reallocation of funds into larger scale infrastructure projects will offset the slowdown in the housing demand, albeit that the most recent data on housing data in China throughout June is starting to actually stabilize again. So I think we kind of get this picture where China sort of muddles through and moves sideways over the next 6 months. But ultimately, if we go into the early part of the new year, I suspect that we start to see a brighter picture for China and the commodity stocks. So the real money flow that is impacting our commodity names is the euro dollar and the upward pressure it's having on the US dollar. So as these political issues in Europe continue to create a stalemate, albeit we have the prospect of progress at the moment where the ECB is providing liquidity into the Spanish banks, and we're seeing the yields on the Spanish bonds and the Italian bonds come down. And most recently, just overnight, Spain had auctioned off 3.56 billion euros of government debt, and that was at its sort of sharply lower borrowing costs than what they were having to pay up a month or so back. So the ECB's willingness to provide the liquidity both into the banks and be a buyer of last resort at the bond auctions hopefully keeps those yields down. But the problem in Europe has a lot further to play out, and the risk is that if the euro dollar remains under pressure as a result of political stalemate, then it puts the upward pressure on the US dollar. And over the last several years, there's been a significant short position in US dollars that have built up that have been long commodities and commodity-linked currencies. I think what we're seeing, not only putting aside the slight slowdown in earnings and the adjustment in spot commodity prices, what you're seeing is at a macro level, I think, large outflows from Australian bulk commodity names after them being a significant kind of long exposure off the back of that sort of carry trade with the short US dollar long commodities. So we continue to keep an eye on the euro dollar as an area of concern. Again, if that was to continue to move lower, then it really delays any probable recovery in the domestic commodity names. And going to the XJO, so what that means for our market is we're trading on historically low PEs, about 10 times forward earnings, which puts us about 20% below historical average. We're coming into our earnings season kicking off in August. As we move through the top 50 stocks tonight, we'll focus on the PE valuations and the earning probability. But broadly, we see our market tracking sideways. We've had a view that a good outcome would be if we could trend back up to 4,250. I think, again, the problem is that it's hard to see US earnings really surprising to the upside. So the next real catalyst to provide some forward improved valuations for the US market is the probability of the Federal Reserve introducing some quantitative easing, and right at the moment there's no guarantee around the timing of that, although Ben Bernanke made it very clear that they're keeping a close eye on the US employment picture, and if the employment picture doesn't improve, which it hasn't now for about 5 months, then they're going to be quick to act and introduce quantitative easing 3. When that happens, it will certainly provide a shot in the arm for the commodity stocks. It'll put downward pressure on the US dollar, and as I've spoken about, as we get into the latter part of 2012, we have these renewed issues around the US debt ceiling, which will be negative for the US dollar, and that'll go some way to offsetting any sort of upward pressure that weakness in the Eurozone's putting on the US dollar. So we're expecting to see the picture balance out by year end. Okay, so that sort of sets the scene for the macro picture driving portfolio allocations. Right at the moment, we've seen this heavy risk-off theme running through the market where, as I spoke about, the market has an insatiable demand for yield, and risk is essentially being thrown out the window in the chase of yield. So as we move through the top 50 companies, AGK falls into that category slightly. So this is one of the few companies where we think, putting aside earnings improvement as a result of bolt-on acquisitions, the underlying business is probably growing at about 5 to 8%. The yield's starting to compress, and this is probably what I'm going to focus on tonight, and keep this in mind relative to where the cash rates are at the moment and where CMTs are sitting. So AGK on a forward basis is trading at around 4% dividend yield, so with 5 to 8% earnings growth. So we've always had a view that around $14.50 is probably fair value. Up at around $15 starts to get expensive. So we keep an eye on AGK over the next 3 to 6 months. Any pullback into this 14.50 range becomes an interesting opportunity for a reasonably defensive buy right strategy, but again, limited capital gain, so it's really a combination of that 4% dividend, getting some pickup from 14.50 to 15, sort of 50 in the capital position of the stock, and the premium from the sold calls. Asiano, so from a PE standpoint, the stock's trading still is looking more attractive, around 15 times earnings. So the stock's on our radar here. We're expecting a high single-digit earnings growth, maybe into the low double digits, so somewhere around 10% earnings growth. So it's a result that we'll look at in great detail when it reports on the 22nd of August. But it's a stock of interest at or near these levels, so somewhere between $4 to $4.30. I think we see that as a reasonable opportunity in the market. Amcor, so we've been recent buyers of Amcor again on the pullback down at $7. We've sold the 7.25 calls. The stock goes ex-div at the end of next month. We've essentially received about 20 cents for those sold calls. So if we have to deliver the stock at 7.25, we've locked in 20 cents of income right at the moment, and we've receiving the return from owning the stock at $7 up to 7.25. A good outcome for Amcor is if it largely tracks sideways into the August dividend period, and we're able to sort of keep the dividend and then get another chance at rewriting the call. Amcor is one of those names that we see 8 to 10% earnings growth. It's reasonably defensive. The stock's not trading on an overly demanding PE. From a dividend standpoint, the stock's paying around 5.5%. So we see the stock pretty well supported. So again, for new money coming into the market, we see this as a reasonably defensive asset that remains attractive to us from a portfolio allocation standpoint. AMP, I think, will disappoint on the downside with earnings results. Arguably, it's already factored in. We're looking for about maybe 3% fall in earnings from 2011 numbers. Interesting opportunity here with AMP is they go ex-div 14 cents at the early part of September. I think the strategy here is owning the stock at or near this level, writing a very tight covered call at around the $4 level, collecting again roughly sort of 15 cents of premium for that, which gives us 30 cents protection to the downside. So we're protected down to around sort of 360 in the stock. And I think that probably covers any risk, and I think maybe given that the stock's already trading on a reasonably low PE of 11 times, I don't see that there's probably too much downside risk as long as earnings don't sort of fall outside that sort of 3% miss, and we're pretty comfortable that that's the case. So we see AMP largely trading sideways from where it is at the present. ANZ, Australian banking stocks, I spent a lot of time chatting about these over previous weeks. 3% earnings growth will be a good result. You've got a similar growth in cost increases. I think you're kind of getting to a point now where, as the market's had this last rally into yield over the last few weeks, the banks are starting to push up against the top end of their valuation range again. I think ANZ, if we could get another 50 or 80 cents out of it, I think it's time to start look at selling those calls. If we can get those set at around that 23.50 level, and preferably if we're going out to December, it will need to be in a Euro style option, so we're guaranteed of locking in the dividend in November as well as the call premium from the December position. But otherwise, if we're looking shorter term, it'll be an American style option, probably only going out a month or two. So we'll start to sort of look at that a lot closer should we get another sort of up night over the next night or two in the US. ASX, so this is pretty much doing as expected, trading sideways. By year end, we really expect the stock, whilst it will have some natural volatility both sides, the fair valuation range for ASX is around $30.50. Again, I've spent a bit of time on this. There's a 6% yield. Our strategy here has been to go out and sell the $31 call into December. We've picked up basically about 90 cents for that, so it's doubled the dividend. So we're earning roughly around about 9 to 10% return on holding ASX for a 6-month period for now through till December. So again, for new money coming into the market, this is an opportunity that we see as a reasonable allocation within portfolios. BHP, now I'm just going to go to some statistics or the numbers on the production report. So that in the last sort of 24, 48 hours, the big bulk commodity names have all reported their fourth quarter production. I'll just skim over some of the highlights from it, given that there's so much information to get through tonight. So BHP reported their fourth quarter production results. Overall, iron ore was solid. Petroleum was a little light. Copper and met coal significantly beat analyst forecast, while all development projects appear to remain on time and on budget. Unlike Rio, however, there was no discussion about the deteriorating macro conditions other than recognition of the challenging environment. So I'll get to that a bit more maybe towards the end of the presentation when we review the macro outlook and the short-term outlook for the Australian market. But iron ore comfortably hit its guidance. Fourth quarter volumes were up roughly 15% year on year. Petroleum volumes were up 30% year on year. Copper strength driven by improving Escondido grades. So total copper production was up 15% year on year. Met coal beat most analysts' forecasts, but still a tough quarter, and that was largely weather impacted, and we spent a lot of time chatting about the impact on the coal market from weather-related matters in Queensland. But all up, following the production result, analysts have sort of cut on average probably their earnings outlook by about 3 to 4%. Already I think the market was preparing itself for a 10% fall in earnings. So when we go out to 2013, what do the earnings look like for BHP? And just to put some specific numbers to it, you're looking at about $80 billion of sales revenue. EBITDA, which is earnings before interest, tax, depreciation, is going to be around $36 billion, and the EBIT line's probably going to be somewhere around between $28 to $30 billion. Now, and that's taking into account spot prices. Now, last time when BHP was trading down at these levels at around sort of $30, keep in mind that iron ore was $60 a tonne. Today it's $130 a tonne. And the average rate that Fortescue, BHP all received for shipping iron ore within the June quarter was maintained at around $125 to $130. Oil was at $50 last time BHP was trading down here. Oil's now at $80, $90. The Aussie dollar was trading at 70 cents. The Aussie dollar's now at 103. So it begs the question, from a valuation standpoint, at what point does the market start to say that these stocks are sufficiently discounted for potential macro risks that lie ahead? I think that this feeds into our view on the Chinese economy, and in particular the Chinese market there. So we're in the early stage of the policy response there in China, potentially starting to gain the traction that it needs. They will start to increase their investment in infrastructure projects. So right at this point in time, the evidence up to the end of June shows that the commodity names had good production numbers, that port data supports the fact that amount of commodities were in fact shipped out of the port, and we get into earnings season and we say, okay, well, where do these stocks look from a PE standpoint? On forward earnings, you're buying into BHP at about 8 times 2013 earnings, and that's historically an extremely cheap valuation to be acquiring these bulk commodity names. So again, for new money coming into the market, we see these as good buying opportunities and a necessity to allocate some capital into these names. So moving on from BHP Brambles, so from an industrial standpoint, trading at about 14.5 times earnings. We've been buyers of the stock down here, and we're selling the 650 calls into September. It goes ex-div around the 16th, so again, this is a name where we're getting roughly 15 cents of dividend, so which is providing about 30 cents of cash flow return between now and the end of September, plus the prospect for about 7% capital gain from the current price point up to around our 650 target. Whilst we're in this period of slower sort of global macro trend, I think fair value for Brambles is maybe closer to 675. If we're selling for long-dated calls, we're out at around this sort of 690 level out to the end of December, and we think that captures the recovery. So for clients that own the stock from higher levels, we're being paid well as a combination of the dividend and the call premium out to that December period, whilst we wait for the stock to recover back up to sort of around that $7 level. But again, for new money coming into the market, we see Brambles as a reasonable buying opportunity here, but being a little more cautious through the sale of a fairly tight covered call at that 650 level. From an earnings standpoint with Brambles, we're expecting the company to deliver around $1 billion of profit and looking for around about 5% earnings growth into 2013. So just bear with me and I'll jump back into that watch list of the top 50. So in the case of CBA, so again this run on yield, we've seen a scramble into CBA. The stock's trading about 12 times earnings. There's no reason to believe CBA is going to materially outperform the other banks from an earnings standpoint. So the stock's extremely expensive up here on any measure, and I think what we start to see is once the stock goes ex-div, fair price for CBA is certainly back at around $52. Coca-Cola trading up at around 16-17 times earnings. The yield's starting to compress below 4%. The company's highlighted that it's only likely to deliver 5% earnings growth, I should say. So again, we're in this sort of period which is highly unusual, where the market has rotated out of risk in a real significant way and compressed yields in these defensive names, and that really started around the time that the RBA moved to reduce rates, and obviously we have the cash rate now down at sort of 3.5%. But it's hard to build an argument that these stocks continue to trade too much beyond where they sit at the moment. It's really been, from a valuation standpoint, from an earnings growth standpoint, and from a dividend yield standpoint, they really are right up against the top end of their ceiling. The argument is that each year they're reasonably defensive. They're going to deliver sort of a fairly bankable 3 to 5% earnings growth. So given time, they should continue to trend higher. But given that you can almost get more money, a higher dividend yield through cash in the bank, once they go ex-div in the next sort of month or two, I think this rotation that we've seen into yield and out of growth or defensive assets will start to unwind, and the actual money will be made by being long the cyclical or the growth assets. So not to say that you don't have an allocation of these assets in the portfolio, but right at the moment, hard to build a case for new money coming into the market to be aggressively long Coca-Cola as an example. Computershare, so starting to move a little bit off its lows. So we've been buyers of Computershare over the recent days at around this sort of 750 level. We're selling sort of 775 calls as on a very short-term basis. Into a longer-term sort of end-of-year position, we're up at around 825. I think that sort of captures probably the immediate recovery for Computershare. I think as we get into the earnings season, we pull apart the earnings results, see what the contribution is from BNY Mellon. But I think into 2013 and 14, Computershare certainly has the opportunity to trade back up towards $9 given the earnings contribution and growth that's going to come from BNY Mellon. CSL, top end of valuation range. The company's in the last stages of its share buyback. There's about 150 to 200 million left to go. They need to conclude that by the end of October, so the stock's likely to remain, fairly well bid into that October period. But from a PE standpoint, the stock's trading at about 21 times earnings. The company will deliver about 10% earnings growth. Keep in mind that a strong Aussie dollar undermines the conversion of earnings back to Aussie dollars. I tend to think that the stock fair value is up at around sort of, fair value from a PE standpoint is back at around $35. I think, again, strip out the last stage of this share buyback, hard to explain the stock price trading too much beyond where it is at the moment. So between now and October, we largely see it staying at or near the current valuation range. Crown Casino, so gaming data out of Macau's pulled back a little. Wynns Casino reported their results in the US last night. Earnings were down a little. The market's largely already adjusted Crown from when it had sort of bullish gaming data at the end of March. It's adjusted for the contraction in growth in China, sort of following sort of the April, May, June period. And I think at around 14.5, 15 times earnings, Crown's fair value here, so it's simply just a way of getting a pickup if you believe that China was going to gradually recover in the second half, Crown's one way of getting some exposure to that recovery story. So Fortescue, let's just take a quick look at the production report here with Fortescue. So quarterly shipments were 17.8 million tonnes versus Q4 production guidance of 15.8 million tonnes. So I spoke about that last week, that the shipments were trending slightly ahead of the guidance that the company provided. So what that means is that their shipping rate of 55 million tonnes of iron ore per annum is in fact being achieved. And there's every evidence to say that the ramp up to initially 100 or 95 million tonnes per annum is certainly on track. The reason why Fortescue's share price has been under pressure is that the market really is not willing to take any risk around companies that will require further capital expenditure or blowout to their capital expenditure budgets. In the case of Fortescue, they have funding secured for all but around $2 billion of the expansion up to 155 million tonnes per annum. And keep in mind that the stock, based on current production, is worth around $5.50. If they're able to increase that to 155 million tonnes, fair valuation is closer to $8. The real issue at the moment is how are they going to raise the further $2 billion. Will it come from debt? Will it come from an equity sell down? The probability is that it will come from debt funding, but again, the market's fairly is providing fairly heavy risk discounts to these commodity names in light of both the global macro issue, the pressures on the carry trade, as I'd spoken about, and discounting sort of any risk that may come down the track as a result of funding shortfalls or capital expenditure blowouts. So anyway, let's just take a quick look at the shipping numbers, or continue that statistic there. So operating costs were around $46 a tonne. So again, their average sale price for the quarter was about $125 a tonne. So it's costing them about $50 a tonne. The market has chosen to focus on the 7% higher capex and therefore put a negative spin on the report, while ignoring the evidence that the port will have a capacity of between 150 million tonnes, as I alluded to, and Fortescue has the potential to creep over 150 million tonnes in a fairly quick time frame. From a earnings standpoint, or from a PE standpoint, if you start to factor in the increase of production, you're coming down to sort of PEs in the order of around 6% in 2013. So we own, from a strategy standpoint, we like Fortescue. For new money coming into the market, our preference is to stay in the larger BHP and Rio. For clients that already have exposure to Fortescue, we've been fairly aggressive with selling those 550 calls into the end of September. So and I'll just move forward on the chart. So we've sold calls up to around 550. So clearly our expectation is that the stock, whilst it could have volatility sort of back down to that $4 range, we see fair value closer to 550 than where it is at the moment. And moving through, so we're not doing anything there in Iluka. IPL, interesting. We're starting to see we've had this rally we're along the stock from around 270. It rallied up to around 310 off the back of the commissioning of the Maramba project on time. It's still trading on a fairly low PE, about 9 times forward earnings. Mosaic, which is the big fertilizer producer in the US, had great earnings results last night. The stock price was up around 5%. I think that's probably the catalyst for today's result. The commissioning of the Maramba project, if you go out to sort of 2015, it has a fairly substantial increase to the EBITDA of IPL, and as we start to sort of gradually see a re-rating back to a normal PE of about 12 times earnings, fair valuation for IPL's up at around $3.50. Our short-term target is to see the stock just above $3, where we then look to sell the 325 calls into the year end. So we're watching this one closely over the next week or two, looking for the stock price to recover back above $3. Leighton's not doing it there at present. Lendlease, so this was on our radar. We always sort of saw it as probably the better exposure within the property sector. They've come out and confirmed their 2012 earnings numbers, so deliver sort of around that sort of 5% earnings growth that we've been looking for. And I think, on a 12 to 24 month outlook, arguably the pipeline of deals that they're sitting on should support a fairly stable earnings picture going forward. So it remains on the radar, but it's not a stock that we've allocated capital to in our internal account at this stage. Macquarie, we've been cautious on Macquarie, and I think that's starting to be supported by the market's view at the moment. The real issue with Macquarie, as I've been chatting about over the last few months, is that their second half earnings results were made up of a number of one-off items that are hard to repeat, and I think that just creates further uncertainty around what the true earnings potential is of Macquarie. But I think sort of you're probably only now starting to get down to a price that reflects fair market value, somewhere around $22 to $24. Given that the American investment banks have been a little uninspiring in their earnings results, it certainly hasn't added any buying support to Macquarie. The only positive here is that the company's conducting their own share buyback of around $500 million, and at the margin, I think they've only bought back about 10% of that at this point in time, so something just to keep an eye on as we sort of get into the sort of September-October period. Maybe they start to pick up the aggressiveness of that share buyback. So our preference has been out of the investment banks and into the traditional Australian domestic banks. NAB's been one of our preferred plays there, but as with all the banks, they really are starting to push up against the top end of their short-term valuation range. If we go out to the end of December, we're happy to be selling calls at around the $25 level in a Euro-style option, so we lock in the dividend in that sort of late October-November period, but it really captures the upside potential, I think, for NAB, sort of not seeing the share price too much beyond sort of $25 by year end. Shorter term into around that $24 level into August, but from an earnings and profit standpoint, as I'd commented with CBA, in this scenario where the banks will be lucky to deliver sort of 3 to 4% earnings growth, we've had the PE or some part of that PE correction scenario that I've spoken about, where PEs were trading sort of at historical low end of the band between 12 and say 9.5, and we're starting to see a little bit of a pickup in that, just as the risk has abated a little in the domestic housing market. But certainly there's not a huge amount of evidence that we're seeing a pick up in loan growth at this point in time, so it's hard to again get too optimistic about the earnings growth outlook for the Australian banks. So it's a matter of selling the tight covered calls, collecting the dividends, and that sort of boosts the annual cash flow return out of the banks up to around 15%, plus the prospect of some capital gain. So for new money coming into the market, we're certainly happy to own these names, and we've been buyers of NAB and Westpac in that regard in the recent weeks. Newcrest Mining, let me just see if I can, for those that missed, I'm just going to bring in a graph that we had a look at last week. So this is a graph of the M1 money supply, which is the amount of US dollars in circulation. And if you listen to Warren Buffett's view on the global economy over the next 10 years, he just has a simple view, is that central banks have no choice but to continue to print money to solve the woes of the world. And his view on that is ultimately that ends up inflationary, and he's happy to own risk assets over the next 5-10 years on the basis that he feels that ultimately the continuation of quantitative easing will maintain some level of global growth And to the extent that that relates to gold, what we're looking at here is the orange line being the amount of US dollars in circulation. And historically, whenever the expansion of the amount of US dollars in circulation, you'll see gold in one form or another tracking that expansion of US dollars. Now, during different periods, you'll see where there's risks of inflation, gold will come closer to tracking that particular line. Where there's periods of deflation, you'll see gold move away from it. The divergence that you're seeing at the moment is running almost at a historical high level. So ultimately, we will see gold revert back up to an uptrend and begin to recapture the spread between the money supply and the valuation of gold. It's hard to tell whether that's going to commence in the next week or the next month, but ultimately, that given that the amount of US dollars are not going to be withdrawn from the system, they're going to continue to expand, you'll ultimately see gold trend back up over the coming years. The short-term issue impacting gold again plays back into this situation where the US dollars rallied and a lot of long commodity positions have been squeezed off the back of the euro falling and the US dollar rallying. So we think, again, for new money coming into the market, that Newcrest actually provides an attractive opportunity. I think it's something that you look back in 6 or 12 months' time and recognise that this is a fairly major trough within Newcrest, both as a combination of our outlook for gold price and as a result of the fact that the company's production numbers are down about 20%, and that's weather and plant related, so we don't see that being an ongoing issue for the company. So gradually, as production begins to pick back up, earnings pick back up, if that production starts to pick back up at the same time as we see gold closing that divergence to the money supply, then we start to see Newcrest trending back up into our fair valuation range of the mid-30s. News Corp, so the $5 billion share buyback supporting the stock at the moment. I think the slight slowdown in the US economy largely sees a price move sideways, but it appears to be a reasonably defensive buy right at these levels, given the company still has $5 billion of shares to buy back between now and Christmas time. Origin Energy, so this has really been targeted by the short sellers, and the company's hand is going to be forced very soon to disclose what their funding solution is going to be, whether they're going to sell down their LNG asset from current sort of around 37% down to sort of low 30%, and if they are, they need to identify the buyer and announce it to the market. If they're going to go to the market and raise capital through a rights issue, then they need to do that. Until they do, short sellers are going to continue to attack Origin, and we see the stock under pressure. Again, that's something that we'd kind of been mindful of going back a number of months, and we got aggressive with selling the calls. We went out to December because we see this as a 6-month issue for the company to resolve, but again, by the time we get into the early part of 2013, expect these funding issues to have been addressed. We expect a slightly better macro environment for commodity prices and commodity-related stocks, and fair price for Origin's back up around $14. So for new money coming into the market, it's a matter of timing, but certainly over the next few months presents a good buying opportunity. Orica not doing their Oil Search. So interesting, out of all the commodity stocks, Oil Search has probably held up the best in a relative sense. And that's, I think, a reflection on their increased reserves that they continue to identify, and their production running ahead of schedule, and that's fed into good earnings numbers over the last, say, 18 months. We've been fairly significant buyers of Oil Search throughout last year, and again, for new money coming into the market, we see it as a value opportunity at or near this sort of $6.50 level. Qantas not doing anything there at present. QBE, our target there is $14.50 into September. I think insurance margins have improved a little, but as I've spoken about, given the yield situation in the US, the risk-free rate of return that QBE is receiving on its monies on deposit is diminishing, or is at historical low levels, and that's probably not going to change anytime soon. So I just don't see that there's a huge earnings uplift there in QBE across the next 6 months. So around 1450 caps the upside there. QRN, we've been buyers of QRN at or near this 350, 330 level. We've been aggressive with selling the 350 calls. We've received about 20 cents for those, so it gives us protection in the stock back down to $3. But between now and sort of November, December, we see it as an opportunity to set long exposure in QRN between this sort of $3 to $3.30 range. I think as you go out sort of 12 months, again, it'll be one of those opportunities that we look back and recognise that it was reasonable value at this point in the cycle. Rio, so we discussed the production results for BHP, Fortescue. Let's just take a quick look at Rio. So Rio reported second quarter production and sales volumes. Overall, iron ore was in line with no change to the outlook, while strong copper performance more than offset disappointing coking coal production. And again, that's weather-related, Queensland. However, the larger than expected exploration charge of $1 billion is likely to see consensus earnings trim. So that's the big thing that's weighed on Rio, and that's just these references to CapEx blowouts that I've been chatting about. So just to skim over the headlines, iron ore rebounds after weather interruptions in the first quarter. So net iron ore sales were basically 2% below forecast. Overall iron ore production, however, was slightly ahead of Rio, as Rio continues to build inventory in the Pilbara to ease pressure on mine development ahead of impending ramp up to 283 million tonnes per annum. And I'll just continue on because there's been, obviously we've seen headline numbers about them increasing that capacity to 350 million tonnes. But so 2012 iron ore production guidance remains at 250 million tonnes, which looks comfortable given the 120 million tonnes delivered in the first half, which was impacted by weather in the first quarter and planned maintenance in the second quarter. Meanwhile, there were no changes to the stated major expansion project progression or completion timing, with Rio expecting the delivery installed capacity of 283 million tonnes by the end of 2013. So we still continue to like this theme of long iron ore and long petroleum. From all forms of analysis that we see, iron ore demand's likely to double over the next 10 to 12 years globally. And I still think that's a theme, whilst it's out of favour and unloved at the moment, it's a theme that still makes sense to invest in. So again, for new money coming into the market, it provides a good opportunity to accumulate these iron ore stocks at or near these levels. We're only interested in touching the best of quality. Again, when you go back to sort of Rio trading at or near these levels, a vastly different company, vastly higher gearing levels. So I think, again, hard to nominate the exact timing, but between now and probably the end of September, we'll look back and recognise that these are fairly good buying opportunities for these large-scale commodity names. And just to put some final earnings numbers around that, so in 2013, probably sales revenue around 67 billion, and EBIT numbers probably somewhere around 23 billion. So whilst we might see a small fall off of sort of up to 10% in earnings growth from the record numbers they achieved last year, factoring in sort of spot commodity prices remaining at or near where they are, you're buying into, again, Rio at a historically cheap multiples of around sort of on a forward basis of about 8 times earnings. Stocklands see flat earnings here, so there's really, if you want exposure to the domestic housing market, Stocklands is a way to get that, trading at around 10 times earnings, paying a dividend yield of around 7%, but I can't see any room for earnings growth across the next, say, 18 to 24 months. So if you're owning the stock, you're required to write the tight covered calls to justify having capital tied up in it. Not doing it there in Sonic. Santos, great example of where the market's just had no patience for capital expenditure blowouts. We've already set our positions in Santos, and it's unfortunately underperforming our expectations. We were buyers of the stock about a month ago at around $12. We'd sold the $13 calls into September. It had given us protection in the stock down to $11.40. The stock's about 10% below our target range. To be fair, we still have another sort of 6 to 8 weeks to run on the trade, so we reassess that as we get into the end of September. From a PE standpoint, the stock's back down around 14 times earnings. Historically, that's provided a good buying opportunity. But the issue here with Santos, as I've spoken about, is the capital expenditure blowout, and Santos's need to contribute $750 million towards that added $2.5 billion investment that's going into the LNG project. So out of favour at the moment. In 3 to 6 months' time, will it still be the case? Probably not. I think sort of, again, we're going through this sort of troughing pattern within some of these commodity names. Suncorp not doing there at the moment. Sydney Airports we're out of. We were buyers of that at lower levels, and we delivered the stock around $2.90. I just think from a valuation standpoint, our expectation is it moves sideways. The same with Transurban, I think pushing top end, and there's a real sort of risk avoidance at the moment as money rotates out of commodities into yield. But, is that a theme that is going to last forever? No, it's not. Will the catalyst to change that be the announcement by the Federal Reserve of sort of quantitative easing, or the US dollar pulling back? Yes, it will. If there's problems that continue out of Europe and the euro dollar falls, it really starts to, unfortunately, delay or put into question, that thematic of the rotation out of the defensive back into cyclical. So it's something that we still have to keep a very close eye on. Telstra trading at about 7.5% yield at the moment. No earnings growth, no dividend, no revenue growth, no profit growth. So it really is just a yield compression story at the moment. Could possibly have a little bit more to run, but post sort of the dividend fair value for Telstra really is probably more in that sort of 350 to 360 range. So Toll Holdings, there's no doubt that value is starting to creep in here from a PE standpoint. The stock's trading about 9.5, 10 times earnings. So I think it's a cyclical that's oversold. Are we buying it on the internal portfolio? Not at the moment, but it's certainly on the radar. It'll be interesting to drill in a little bit deeper to the Toll's earnings results when they come out on the 27th of August. But our expectation is the market's already, or Toll's already advised the market of what the earnings number's likely to be. The market has adjusted for that. Will 2013 be less than 2012? At this point in time, unless there's a significant slowdown in global GDP, probably not the case. Oil prices have come down a little, which at the margin assists Toll. So it starts to become interesting at these levels, but our preference right at the moment has been to remain sort of long the commodity names as an exposure to sort of any type of cyclical sort of upturn. In the case of Westpac, we've been buyers of this at around $21.50. We've sold the $22.50 calls. They're the European style, so by the time we strip the dividend out, we simply don't see Westpac sort of ending the year too much beyond sort of $22.50 to $23. Westfield, top end of its valuation range, yields now at 5%, 2 to 3% earnings growth. Other than the company continuing to buy back a small amount of their shares, there's little reason for the stock to continue to move higher from where it is at the moment. We see fair valuation back at around $9.25. Wesfarmers, so pushing up as it comes into its dividend. From an earnings standpoint, and PE valuation is pretty much fully priced at about 14.5 times forward earnings. As the market's rushed for yield into the upcoming dividend season, We've taken the opportunity to sell the $31 calls into December, so it's essentially doubled the dividend yield between now. So again, we're getting roughly about 10% yield out of Wesfarmers for holding it from now through till December time, and in most cases we'd bought the stock at lower levels at around $30, so there's room for some capital gain there as well to deliver the stock at 31 at the end of December. Again, they're European style, so we don't have a risk of being called away for the dividend. Worley's not doing there at present. Woolworths really sort of tracking sideways, again getting up to around sort of 5% dividend yield, or 4.85% dividend yield, trading at about 14.5 times earnings, starting to just get a little bit expensive. We've seen sort of low inflation numbers within the sort of food divisions of Metcash as an example, and I think that probably bodes or supports our view that both Woolworths and Wesfarmers struggle to deliver earnings growth above sort of 5% in the 2012 results. Woodside Petroleum, I think this is a value opportunity. It makes sense for new money coming into the market to own. And across these commodity names, we really wouldn't want to see new exposure, to match our internal account, sort of much above about sort of 30-odd%. It still requires a reasonable skew towards the defensive assets as you try to sort of navigate the timing of shifting funds into sort of these cyclical names between now and September. Westfield, not doing there at present, and then back to AGK. So just to conclude tonight's presentation, just wanted to quickly jump back into the XJO and speak about where we see the market heading short term. So again, as we enter US earnings season, we've had the investment banks report over the past few days. We get into the large multinationals over the next sort of 5 to 10 days. Early indications suggest that earnings are trending pretty close to our target of $25 a share. The Australian market trades on a lower PE to that of the US. I think that's largely driven by the higher bank funding costs and the lower PE that ascribes to our financial sector, and obviously the lower PE to our resources, and given their high rating within our XJO index. So 42.50, we've always sort of had a view probably captures any upside recovery throughout US earnings season, and I think following US earnings season, the base case is that the US tracks sideways at around 12,500 points, and again in that environment our market spends the most part of the next 6 to 9 months trading within this sort of shaded range here on screen. So it really does require, for portfolio allocations, it requires staying reasonably defensive, selling tight covered calls, but given that the cyclical stocks appear oversold at the moment and with the stimulus measures that are likely to come through from central banks, it makes sense to start increasing some exposure to those names in the lead up to the next 6 months. Thank you for listening in to tonight's recording. I look forward to speaking again next week.